Hey investors, Bradley here from Watson Estates, and you're listening to the largest and fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts. Today, our guest on the show is August Biniaz. We're excited to have him come on from CPI Capital, and he's going to share with us this concept of building a real estate private equity firm. Maybe you've been doing joint ventures, shareholder agreements, as I have, and you're really thinking, what is the next logical step? Are there other ways to structure my deal to really scale my portfolio, maybe even across borders or across provincial lines? Well, these are some of the topics we talk about on what does that look like and how to create a successful private equity firm that invests in real estate. If you want some of those details on how the big wigs, successful investors and general partners interact with their limited partners and with their capital partners, then this is the show for you. When you love this episode, please share it on Instagram. You can tag us at Watson Estates and support the episode overall. Hit the like and comment if you have a question for myself or August, and enjoy the show. August, thanks for joining us on the show. How you doing?
Hey man, big pleasure to be here today. Can't wait to have a nice discussion with you.
Yeah, I'm excited. And we're going to talk about a topic that I can't say I know too much about, but you clearly are an expert in, you and your company there, CPI Capital. We'll get an opportunity to talk a little bit about what you guys are doing, and maybe that's a good place to start. But I'm curious. Tell us a little bit about yourself. Like, what got you into investing in this space and in real estate? And I guess where are you guys headed right now as a company?
Yeah, long story. I'll just briefly start with my background. So August Biniaz, a co-founder of CPI Capital. CPI Capital is a real estate private equity firm with its mandate to acquire U.S. multifamily assets while partnering with retail investors as our limited partners, both Canadian and U.S. investors. And my background in real estate started a while ago, 16 years ago, as a licensed agent. I wasn't the best real estate agent, but I was good at finding deals. When you're in a ocean of a lot of fish, I think over 20,000 real estate agents here in BC. Is a very competitive market. I was good at finding deals. I was good at management. Started doing small fix and flips. Started my own general contracting company, moved on to building single family homes, more on the luxury side, and both spec home and custom homes. So I was hired as a builder to build homes for others. Also would be building homes for myself, for my group of investors that initially started with friends and family. And I always wanted to scale. Eventually did a multifamily project, a 20-unit townhouse development project, where I found the project, brought on the investors. I didn't have the capacity to be the GC on that larger multifamily project, so I brought in the GC, brought in all the professionals as well, and I got a portion of the profits. I fell in love with that model, this idea of finding the deal, finding the investors, and getting the portion of the profit, and kind of started my journey on the real estate private equity realm. That's where I am today. I co-founded CPI Capital a couple of years ago, but at some juncture, I realized that the asset class I was involved in, the ground up development project here in Vancouver, wasn't as glamorous as it's made to be, sounded. A lot of large development firms have bought properties on pennies on the dollar, and it's a lot easier to scale. It's actually a pretty difficult business to scale, as a smaller developer. But when I looked to the US, I realized that there was a business model that was much easier to achieve, which was multifamily syndication business model, that rather than doing a ground up development, you could buy an already built apartment building, do some small renovation, and then sell it in 3 to 5 years while partnering with investors. But we can get more into that if you like.
Yeah, definitely. So very good intro. And I love to hear that backstory and where you've come through. I think a lot of investors will be able to resonate with that. And we'll have investors that are like, whoa, like this is just 10 steps ahead. But even knowing what that map looks like, I think will be very helpful. And I guess to kind of start us off, and I want to really dive into every aspect of how would someone if someone wants to start this private equity firm in the real estate business like you're doing, how would they do that? And that's really where I want the show to go. But I think we need to kind of, I guess, define what we're talking about a little bit. And I think you did it a bit in your intro there. But for me personally, for our listeners, they know, like, we do joint ventures and they're a lot smaller deals. It sounds very much like what you were doing, you said, out in Vancouver. but there is definitely, like you mentioned, syndication. And then when we talk about private equity firm, could you just explain for our audience kind of what those differences are, what that transition looks like? Yeah, just give us a little bit of a scoop on that so we kind of can frame where we're headed.
Yeah, no, absolutely. I'll start up by first defining what private equity is. Private equity, I mean, the name is in it, right? Private equity, private capital. And the difference between private and public is you're raising capital from private individuals, either institutions, family offices, institutional investors, or retail investors, high net worth investors, accredited, non-accredited investors. That's the realm you're raising capital from. You're not going to the public markets. You're not going through an IPO to raise capital. So private equity firms historically are raising private capital to buy companies and make them perform better and then exit those companies. The real estate private equity space is companies that are focused on buying real estate assets while raising private capital. Kind of the progression, the transition, and the progression that I went through was out of a need. So when you're buying, when the goal is to continuously buy apartment buildings, continuously follow the value add model, you're in need of consistent flow of equity, and that's when you're basically managing a real estate private equity firm. You're consistently raising capital, consistently connecting with investors, cultivating and nurturing relationship with investors, and then on the other side, you're continuously underwriting deals, doing due diligence, and putting deals under contract and acquiring and managing projects. So the company is kind of divided into those two spheres. Now, syndication is another phrase. It's synonymous with real estate private equity. Syndication is just a process where it means that two groups coming together for a combined mission, and a few members of the group are the management group, and the other members of the group are bringing capital, or they're silent partners. But that silent portion is very important, because in most cases in real estate private equity deals or syndicated deals, the structure that's used is a limited partnership. And what a limited partnership is a partnership between a general partner and a limited partner. A general partner manages the project, finds the deal, brings on the investors, basically manages the whole deal, and the investors are just silent partners. And the reason they're called limited partners is because they have limited liability. The liability is all on the general partner. So this partnership allows for them to do a business deal, and I love this model, because it is the investors, the limited partners, is very aligned with the limited partners' profits, and their it's a very risk averse process for limited partners. So you can get more into that if you like.
Yeah, it sounds as though the activities haven't changed, in that you're essentially finding deals, finding investors, but there's clearly a formality that's built in a process, and almost a business built around funneling those two categories. And clearly with limited partnership, a structure that is different. So it just sounds like you guys are doing joint ventures, equity partner type of deals in a much more formal way, where an investor can, I guess, have a level of confidence knowing you guys, have done many of these similar deals, and there's a steady flow. So it sounds to me, and pardon my ignorance, it sounds a lot more just like a structured version of what a lot of investors, even in the GTA, are probably running around impersonating today. Would that be a fair statement?
It is, but there's also a important difference between doing a JV and doing a limited partnership or private equity structure, is that in a JV, your partners are not silent. They're involved. They could come in and they have a say within the limited partnership structure, the private equity structure. The limited partners are silent. They're signing a 200-page subscription agreement, explaining that their position is totally silent, that they trust the general partner to make all the decisions, as far as the capital expenditure, as far as the exit strategy, as far as the whole time, all those other decisions. Whereas a JV is much more involved, much more hands-on, and also on the compliance side as well. If you have a JV, the compliance aspect of it is not as restrictive as it is when you're dealing with private capital. As soon as you're raising capital from private investors, that's when you have to oblige by security compliance across Canada and the US if you're raising capital on both sides.
You actually hit that. That was going to be my next question, is what does it look like from a compliance? So obviously we have securities. Are there other, I guess, weight that what's the term? Like weight or baggage, let's say, that you guys as general partners need to carry beyond those compliance as well, given, I guess, to maintain that protection of the limited partner and, I guess, credibility as a general partner.
Yeah, no, exactly. So one important part of our business is as the limited partners, when they invest, they receive limited partnership units. Those units are considered securities. So a portion of our business is the sale of securities. And I mean, that's a very important part of our business. And we have to, oblige by the security compliance across Canada, depending on any province that we're raising capital in. So the decision that CPI Capital has made is that we've partnered with an exempt market dealer, and our securities are actually sold through the exempt market dealer rather than being sold through CPI Capital. So the EMD that's licensed through multiple provinces that we sell our securities in, that EMD conducts the KYC and KYP. So they do a KYP, know your product, on us or on our firm and on every deal that we bring to our investors. And they do a KYC, know your client, on every investor who wants to invest with us, to ensure that an investor is the right product for them. If it's somebody that got $20,000 in the bank and that's their last $20,000, you don't want to invest that whole money, but it doesn't really make sense, right? As far as the risk.
So you guys do take on private investors who are not accredited as well? It allows you to kind of reach beyond just accredited investors, or obviously close friends and family?
Not so far. So, till this moment, we've only dealt with accredited investors. But we are taking the steps to allow for non-accredited investors to join as well. There's an exemption called the crowdfunding exemption that allows us to bring on non-accredited investors, which we're exploring with our legal advising team.
Cool. Yeah. I mean, you guys obviously have structures and you understand that legality. And what terrifies me is that a lot of folks doing joint ventures are doing the things that they shouldn't be doing, in that they're trying to look more like a general partnership, limited partnership, and they're not following those proper procedures. So I guess to heed some warning to some of our listeners is, if you're going to start to go in this direction where you're bringing on securities. I mean, we even have, what's interesting to me here is you guys have a structure in place and you're aware of how to bring on non-accredited investors. And yet even still, it's taken this long and you haven't yet done that. So I guess let that be a bit of a warning for people running around trying to market their product on Facebook to raise capital. You can really get yourself, and I've seen investors get into some pretty hot water. So
yeah,
okay.
No, as far as the marketing side of it, I'm not an expert. It's very gray when it comes to marketing a deal. But when it comes to a joint venture, if you create a company and you buy this company with your joint venture partner, you've already triggered compliance. You've already sold. Those are considered securities that you just sold. So you've already triggered the private issuer exemption, even if you have one investor who's partnered with you. So just keep that in mind. And security commissions can oversee, instruct you and oversee you and basically make the recommendations if needed. So just
just to, I guess, speak that back, make sure we're clear. So if you find a deal and you locate an investor after finding that deal, you qualify under securities.
The moment that you are allowing someone to invest with you, and they've now, if you've done it through a structure of a corporation, or you guys have partnered up, you've already triggered the securities regulations. So you're already being overseen by the Securities Commission in the province you raise capital from, or in the province that you created that partnership from.
Good insight. Love it. Okay. So let's get into the different, I guess, aspects of what you do. And we'll kind of maybe break it down by segments, and forgive me if I miss a category, but maybe we'll start off by locating deals. I think a lot of people are like, how do I find these deals? You're doing it on a multifamily space and large real estate portfolio, but you obviously have a history all the way through. So I'm curious, how does CPI Capital, or you personally, how do you locate the deals that you see as value add opportunities that would be beneficial and obviously provide a nice return to your investors?
Absolutely. It all starts with the region. So obviously we're investing only in the US, and the reason for the US is that when I initially wanted to focus on the business model of multifamily value add, what it means is you buy on already existing apartment building or an already existing apartment community, which we're buying recently. And the difference is an apartment building is just an apartment building, and a community it could be multiple buildings. It's got a amenities, a pool, a gym, and other amenities within that complex. So you're buying the whole community. Within that business model, the general partner or the whole partnership is profiting from the rental income, from the rent cash flow, and from the back end profits when the value add business model is been completed and the project is sold. What we realized early on is to duplicate this model here in Canada was going to be impossible because the rent to value ratios are so low, the rental yields are so low. Now, some people might hear this and say, no, I found this great multifamily deal that it was cash flowing. Yes, unicorns can be found, diamonds in the rough could be found, but it's not a consistent business model, which is the norm. Whereas in the US, particularly in the Sunbelt states, it's the norm to be cash flowing. In Toronto, most of Ontario and Vancouver, you got cap rates around 2.5%, 3%. And in most of these Sunbelt states, the cap rates are at 5%. So it allows for that cash flow to come in, and when you do a conventional mortgage at 70-30, from the rents you collect, you can pay your mortgage payment, taxes and fee, a third-party property manager, and still have a surplus to give cash flow distributions back to your investors. So we knew right away that we want to be in the U.S. Also, many other reasons for the U.S. You got over 300 million people. You got an interstate migration happening in the U.S. You got people with one of the highest incomes in the developed world. And also that ratio of income to rent is very high. So it's a great place to be involved in, in the rental business is a great place to be around the world. And so far, I haven't found a country that has a higher rent to value ratios than the US. So it starts with a region. So that's kind of my thesis on the US. Now, the regions, we look at the Sunbelt states, these red states, Republican states, which are very tax friendly and business friendly, starting from the West Coast, Nevada, Arizona, Texas, Florida, North and South Carolina, Georgia. And there's also interstate migration happening. People are moving out of California, New York, moving to these states, lower cost of living, and many jobs, many Fortune 500 companies are moving there as well because they get a lot of tax benefits, as you can see with Elon Musk and Tesla and many other companies. So starts with the region initially, finding out what is the best region to be in. What's the region that shows consistent growth, consistent job growth, population growth, income growth, and rent growth. And as long as those growth measures have been shown in the last few years, the chances of them continuing is very high. So that's the region we want to be in. And then we work with our asset manager, and we have two separate business models. Either we partner with an active operator in that region who acts as our boots on the ground, or we look for our own deals to acquire it directly. So that's to answer your question in a very long way.
No, but you know what? I love the thought process. And I think there's a lot of relatable info in there. And even when people are looking at local deals, like that is very much the criteria. It's also what has a lot of people terrified about the market in Ontario. So we have a lot of these same benefits, but there are some that have obviously, when you talk about rents to cost of purchasing a property or rents to income, we don't really fall in that top metric. So I could see a lot of people and I've talked to a lot of investors that can resonate with the things you're saying. I find it interesting at the tail end there. You said you work with operators in the area. And I think a lot of people are nervous about crossing borders or provincial lines because they don't feel like they have the ability to manage at a distance. But I love how you just kind of like added that in there. Like we'll connect with an operator. And I think recognizing that those operations are available and willing to work with you, of course, would actually be although it's simple, I think it will open up a lot of eyes. So I'm curious, how does that relationship work within your current structure? Are they also locating the deals? I guess now that we've located our where we're going to be investing, how do we then find those deals? How does that kind of on the ground operation take place, whether through this connected operator or through your corporation?
Absolutely. And before I get into that, let me just make a important distinguishment here, because if you're a passive investor and are looking to invest in a syndication into a real estate private equity firm and then to invest with a US operator, I would strongly suggest against that, because most deals are structured in the US in an LLC, a type of structure that we don't even have here in Canada. We have limited partnership or a corporation. In the US, they have limited partnership, LLC, or a corporation. This this kind of a combination of a corporation and a limited partnership, which is LLC, is actually not tax efficient. And a lot of times Canadian investors have invested in these investments and they've got double tax. That means they're paying close to 70% of their profits in taxes, both in the US and in Canada. But if you're looking to, as an active investor, looking to start investing in the US, then I definitely recommend the option of partnering with an operator in the US that acts as your boots on the ground. So that's kind of just get that out of the way. Now, when it came to
sorry, just to leave that off as well, what is the structure that you've seen best executed for Canadians investing in LLCs or in corporations in the US?
So again, it goes a bit different. So for us, since we manage a real estate private equity firm, we have to raise capital into a Canadian fund from our Canadian investors. And then on the US side, we create a US fund. So the Canadian fund invests into the US fund just as another limited partner. And then US investors, they can invest directly into the US fund. So that's the structure we use. But that structure might be too costly and cumbersome for an individual looking to invest directly into a US syndicated investment.
So that's great. So what would that individual do if they didn't have those hoops to jump through, or they didn't need that kind of process? If someone had one partner, my uncle's putting in money and I'm going to be managing it in the US, what would that individual be best to do? Would they just simply open up a corporation in one of these states, send the money over and invest? Just that simple? Or is there a process that needs to be set up for them as well?
They definitely need to discuss it with their accountant about how to go about doing it and what's the best strategy for their situation. Also, one of the main questions they want to ask is repatriation of funds. Are they investing capital in the US? Are they planning for those funds to come back? Do they continuously want to reinvest in the US? So those questions come in. And is the partner that they have in the US just a US operator that they're investing with, or is that person connected to them? Are they part owner of that entity in the US? So all those things come into play and makes it more complex. But one advice coming from me directly is don't ever, as a Canadian, invest into a LLC in the US. If done directly or if done through a entity you create in the US, being a corporation, being a limited partnership, or your own LLC, if the deal is structured in an LLC, it will not make it tax efficient for Canadians.
Good advice. All right, let's talk about some of these deals. So how have you seen these babies pop up in an organic way for your corporation?
We're definitely getting into that. So our situation was, when we started CPI Capital, our mandate, our goal was to bring in the best possible investment for our investors. And that was institutional multifamily assets. And institutional meaning that an asset is, in today's case is 200 plus stores. And we're talking about a large multifamily asset. And the reason they're called institution is historically institutions would invest in these assets. So that was our mandate, bringing institutional quality assets to investors. And we were still a smaller firm, still connecting with investors. We were very much involved on the content creation side and the educational side of things. We realized that a lot of our time is being spent on cultivating and nurturing relationship with investors. We had our underwriting team, we had our asset manager in-house, but it made sense for us to partner with an active operator that was going to conduct a lot of our work on the ground in the US. So that's when we came up with this business strategy. And we noticed that the same business strategy was being utilized on the large scale side, on the institutional side. We noticed that the Canadian pension fund in partner with Greystar, one of the largest multifamily, I think is the largest multifamily operator in the US, to invest in the US. So we realized, hey, this is already happening on the institutional side. We could mimic the same model. So we ended up partnering with multiple groups. Now, obviously, we put those groups through a detailed vetting process, and we had certain requirements for the group. For example, they had to have at least $100 million of assets under management. They had to have taken deals through its full cycles and returned capital to their investors. They had to have never lost investors' capital, and there was also a level of transparency we needed from them to communicate with their past investors, with their law firms, with their accounting firms, and what have you. So that's the business model we utilize at that stage to partner with our U.S. partners to acquire these assets, and for them to be our boots on the ground asset manager as well.
Very good. Okay. So I think that's good for locating these deals, and I love the way you've leveraged the local talent and kind of positioned yourself with people that are doing well. So now on the capital raising side, which clearly is, I guess, that other major component, and I'll actually after we're done discussing this, I'd love to see if there's any other categories that people often ignore that makes a successful equity business that you guys are private equity business you guys are running. But for the sake of raising capital, what is the primary way that you guys, obviously you have a system of vetting, and we don't need to go into the securities aspect again, but how do you attract that capital? A lot of people are stuck on that side and they're wondering, what do I do? And I'm curious, what are some of the strategies you found has worked?
No, for sure. I'll get into it. So there are people who are, very lucky and gifted. I was reading a book about Steve Schwarzman, the founder of Blackstone, and all he did is when he quit his job at working with one of the big banking firms, he just made a few calls to a few institutions out of Japan and a few other places, and he had easily raised, I believe it was $300 million on his first fund. So that's not going to be the case for most of us looking to do real estate deals. So, for example, I'll kind of walk everybody through my journey as a single family and a multifamily ground up developer here in Vancouver. I believe that if I would bring these great opportunities in the U.S. that were much more profitable than the deals that I've been working on over the years, because they provided cash flow, they provided better returns on the exit, but also an ability for forced appreciation, because we would go on and do the value add business model. So it had a trifecta and brought the risk much lower and the chances for returns much higher. I believe when I brought these deals to the investors who I had in the past made a lot of money for, millions of dollars in some cases, that they would just jump on and come on and invest with us. But the process wasn't as easy or wasn't as quick as I thought, because you're talking about a deal in Florida. They're like, hey, great, I like to vacation in Florida, but how does this work? Now I got to deal with the IRS, other issues. So it wasn't as easy as I thought. Also, even if all the investors that I'd worked with would have invested with us, we needed a continuous machine, because we're buying these large institutional assets. We're talking about, tens of millions of dollars. The smallest deal so far we've acquired has been $30 million USD. So the amount of equity needed consistently needs to be there. So we knew that we needed this machine to be continuously working. So we explored going through the broker route, the exempt market dealer route, but we realized the cost of capital on that route is very high. You're looking at between 7 and 10% for cost of capital. And in our business model, that didn't really make sense, because the whole partnership pays for that cost of capital. It's not CPI, or it's not the investors, it's all of us paying for it. And didn't really make sense. So the route that we took was the content creation, the educational route, the becoming thought leaders in the space. That if you're Googling Canadians investing in the U.S., that you would see either August Biniaz, Ava Benesaki, one of our other leadership team members, or CPI Capital. So it would funnel investors to us, at which time they can see us, they can know us, they can like us, they can trust us, and eventually invest with us. So that's the route we took. Obviously, we have to, again, comply by securities regulation. We're going to have to go a little bit more into different exemptions that exist, but that's kind of the route that we took. Yes.
I love that. I love it. Do you find most people who do invest with you have had a portfolio in the past, or do you get more? I guess you mentioned you did accredited, so I would assume that they've got at least some kind of portfolio playing out in the back. I do like the concept. I think it's clever, knowing that the deal is so good. How can you pass it up? Not to mention, I know from my experience in raising capital, when people feel like you're adding value. So if they feel like you're walking in and simply, you're just taking my money and buying something I could have bought, it's a very hard no. But as soon as you introduce them to a concept, i.e. doing some of these setups you guys currently have with properly set up and thought through with operators, and having that system in place makes that yes a lot easier. So I can definitely see how that would play out, and at least not work against you, where I think a lot of people are maybe fighting an uphill battle because they're not actually adding true value. They're just, panhandling.
Exactly. There's a great book, Magnetic Marketing, and that go over that kind of adding value and giving something right up front, which then brings the person in. It could be utilized on all different types of, doesn't have to be real estate private equity, but it could be used in any business really.
Yeah. So do you have any category? So obviously you've got these two big behemoths. You've got finding deals, raising capital. Is there a new category that you guys have kind of found, or something that fits somewhere in between that allows you guys to run more efficiently than say any other private equity firm that's operating today?
It's really the marketing, right? So it's all the marketing, it's all creating all that content that creates the funnel, brings the investors in. They go through a nurture process. They get to know our firm. They get to know our team. They get to know our leadership team. A lot of content, a lot of value is being added to the investors. And in our case, we're not managing a fund, so we're not continuously raising capital and continuously acquiring deals. We do syndicated deals, so we're project specific. So as they're, in their investment journey and their process of learning about us and receiving our weekly newsletter, then we have a deal that comes in. That email goes out to our investor community. We advise them that we have a deal under contract. There's a webinar coming up. Everybody's invited to our webinar where we go over the deal with our investors, and at which time then they have an opportunity to do a soft reserve and eventually turn that soft reserve into an actual investment and transfer funds.
I'm curious. So what does a guy that's reached the level that you have do next? Do you guys have any intention of eventually going public? Is that a natural progression at some point, or do you see this kind of being the end? I'm curious. We've obviously seen you go all the way through these steps, and a lot of people, would idolize or at least want to copy in some capacity. So where does a guy like you look to go next, or where does this eventually lead when you're kind of sitting down and thinking about the next 10 years?
Yeah, the natural progression seems to be going public into finally a REIT, and you can see that with Sam Zell, who started in student housing many years ago in the 70s, I believe, and now he has the largest real estate REIT in the U.S. But for us, I mean, there's a lot of steps before getting there, so there's a lot of milestones for us to achieve prior to getting to that spot. So the next, I mean, some of the milestones that we have, internal discussion is being at $1 billion of assets under management. We're still looking to grow our own asset management team in the regions that we're very focused in as well. So there's a bunch of different milestones. Also, there's the route of also having a fund alongside our syndicated investments. So that's another progression a lot of teams go through, is that they do their project-specific syndicated deals, but they also have a fund. So if you have an investor that comes in, they can then invest into your fund because they don't have just capital sitting around waiting for your next deal. So it's just, having that consistent deal flow, having that consistent investor onboarding process and merging both. But yes, great question though. Great question.
All right. So I'm sure we've got people at different levels that probably have questions and want to reach out, maybe, chat a little bit about some of the deals, which we haven't even gotten into any of those. I'm sure there's plenty of good stuff there too. Where can our audience, as they want to reach out, because clearly you guys are inbound and ready to chat, where are they best to locate your team at CPI Capital?
Absolutely. Our website, cpicapital.ca. I'm also personally very active on LinkedIn. So you can find me on LinkedIn, August Biniaz on LinkedIn, or you can also search CPI Capital on LinkedIn. I'm sure it comes up. And mention that you heard me on Watson States. So then I'll go ahead and book a call with you, a 15-minute complimentary call. And if you have any questions, I'm more than happy to answer it. But make sure you mention the show.
Sounds good. August, thanks, my friend. Appreciate you coming on and sharing some definitely new information, and hopefully get people really excited about where their real estate journey is headed.
Absolutely. My pleasure.